Hello and welcome to this seminar on India's public finances. My name is Suyash Rai. I am a fellow at Carnegie India. I am joined for this webinar by my friend Josh Felman. Josh is a macroeconomist who has worked for many years in the IMF. He was IMF's resident representative in India. He now runs a consulting firm called JH Consulting out of Washington, DC. Josh's expertise is in two areas. One is India, and the other is crisis. And when India is in crisis, he is the best man to ask what to do and what's going on. He spent many years studying India. He spent many years working in India. He spent many years working in countries in crisis, from Indonesia to Philippines to Korea while they were going through crisis or reconstructing from crisis. And the way we will do this seminar is that I'll make a presentation for about 20, 25 minutes, maybe up to 30 minutes. And then I'll invite Josh to share his comments on how he sees India's public finances after the Union Budget and the 15th Finance Commission report. And I'll invite him to speak for about 10, 15 minutes. And then we will have maybe a back and forth for a couple of minutes. And then we'll open up for questions for about 15 odd minutes. I'll now share my screen with you. I have a slideshow which I would like to show you. Yeah. Uh, yes. So I'm going to offer a narrative of what's been happening in India's fiscal system for the last 5, 6 years. I'll do this in three parts. The first part is to talk a little bit about certain transformations that have been underway in India's fiscal system since 2015, especially. And the argument I would like to make here is that India took on a number of key transformations in the fiscal system over the last few years. Most of these were actually works in progress over these years. And then suddenly the 2020 crisis hit in the Indian economy. And because of that some of these transformations were affected also. And some of them will have to make, so the government will have to make changes with respect to these transformations because of this crisis. Then I'll talk about what are these adjustments that the government has made in the 2020 crisis. These are still ongoing adjustments. It's not yet a done deal. And then briefly, I'll touch upon what seems to be the strategy that emerges from Union Budget 2021-22, and what are the things that we can read from the 15th Finance Commission report. So let me begin with the first part. What were the key transformations that happened in the fiscal system since 2015? Uh, if you look back, take a long view of Indian fiscal system, the last 5, 6 years have been particularly eventful. I mean, there have been periods where lots of changes have happened, but not so many changes in one go. So there have been huge changes in the last 5, 6 years on intergovernmental transfers, so union-state relations. There have been major changes in the tax system. There have been major changes in the mechanism of delivery of subsidies. There have been very significant changes also in the laws that govern the fiscal management in India. So let me talk briefly about some of these. So the first big change that happened was soon after the Modi government came to power in 2014, when the 14th Finance Commission submitted its report. And this was a complete reimagining of intergovernmental transfers, a quite substantial change from what was happening for almost 4 decades previously. And they recommended a big change in the form of an increase in the state share of centers taxes. And so from the divisible pool of taxes, the share of states was recommended to rise from 32% to 42%. It was the single biggest increase in devolution by any finance commission. Uh, and as an aside, they also discontinued some of the specific grants that used to be recommended by the finance commission as grants in aid to states and other bodies. And the net result of that was that the big change happened in the composition of transfers to states, from more specific purpose grants to much more untied funds were made available to the states. So this slide shows all the finance commissions till now, from first to the 14th. 15th is underway now, and as you can see, the change by the 14th Finance Commission was the single biggest jump in terms of percentage points as the state share or in centers taxes. And this graph is also telling in other ways. For example, whenever there is a big increase in the state share, afterwards there is a rebalancing that happens usually in the past. But that's point one. The other point that this graph shows is since the late 70s or early 80s, there was a certain kind of settlement as far as the state share in central taxes was concerned. And so the change that happened in 2015 onwards because of 14th Amendment was quite significant. And this kind of a change takes its time to settle in any political economy, but especially India's political economy, because other adjustments will happen as a consequence of something like this. And this was underway when the crisis hit. The second major change I talk about is the Planning Commission's evolution. Planning Commission was a very powerful body. Its role had changed a lot over a period of time. It had an important role to play in unions, government's budget management. It also handled the plan expenditure, and its evolution therefore had a consequence for the expenditure classification system itself, because there's no planning commission, there's no point of having a plan expenditure as such. And it also had a role in union state relations, fiscal relations. So they used to approve states plans, they used to monitor states expenditure and so on. And all those things, I mean, basically went away along with the planning commission. There was an elimination of the plan non-plan distinction, and there were many problems with the planning commission, and there were good reasons perhaps for its evolution also. But there was one good thing about planning commission. It uh, ensured that at least some part of the government expenditure, which is about 30% of expenditure, which was plan expenditure, had some medium term strategy underpinning it. And it used to protect that expenditure. It had a medium to long term view of that expenditure. But evolution of planning commission left this question open: how will India do medium term thinking in its expenditure, in its budget management? And those questions were still being answered and are still being answered. I mean, they are not yet settled, and we are still working our way through this change as well. This slide just briefly shows how the planning commission's role had changed over a period of time. Earlier, plan expenditure was primarily about capital expenditure, and even the revenue expenditure there, which used to be grants made, a lot of it used to be for the purposes so that states and others can actually do capital expenditure. But over time, plan expenditure, the share of capital expenditure and plan expenditure had fallen quite a bit, and also the plan size itself had become a smaller part of the overall government expenditure. So from about 40% earlier to about 25 to 30% in the recent years. But still, it was quite a prominent part of the Indian fiscal system. Third, and possibly the most consequential in the long run, is the goods and services tax, which was introduced in 2017. It took a lot of legal effort to make it, political and legal effort to make it happen. The center and states had to come together. They had to pool their sovereignty to and then amend the constitution. Then the parliament passed the laws that drove it, and something called the GST Council was established, where the center and states come together to take make recommendations about rates and other aspects of GST. This subsumed many of the taxes and duties. A number of choices were made, are still being made about rates, jurisdictions, administration, and so on. This is still a work in progress, and it is also something that forms the background for our discussion. If you look at this GST, in just the first 3 years, uh, the under GST, about more than 700 notifications were issued. Many of them notifications were to clarify GST, to improve things here and there, because it was a work in progress. And as it was launched, it was understood that this kind of a reform will take its time to stabilize in India. And this stabilization will happen if there is trust between center and state, if they can come together to discuss things in in the GST council meetings and resolve them. Like one example of the way GST has evolved is just to see the rate structure itself. When it was launched in 2017 July, 228 different items were in the 28% slab, which is the highest slab on the GST. Now only 36 of them remain in that slab, and others have the rates have been reduced. So the government has learned, it has improved many things, but there are still many unresolved issues that remain to make GST a much full, I mean, live up to its full potential. So there are issues around input tax credit. Reconciliation is very challenging in the Indian context, and it has blocked the system of input tax credit. Return filing is still complicated, especially for small businesses. Even though government has given many reliefs, still there is some way to go. There is lack of jurisdiction. I mean, lack of clarity on jurisdiction on center and state and different states. There is an anti-profiteering authority that has been set up under GST, which is quite draconian in its powers, and its working is still yet to be properly understood. And it will also probably require some reform to be able to actually work without harming the businesses. So there are these kind of issues which were being worked out over the last few years, and uh, also in terms of the GST's collection and fiscal marksmanship. And GST for the last 3 years has been very difficult to actually budget for. So the budget estimates and the actuals, there's a huge difference usually, because it's been very difficult for government to actually predict how much GST it would collect. It's still learning this, and over time, hopefully, it will get better. Interestingly, when the crisis hit, which is the pandemic, the COVID crisis, it was the first time that 4 consecutive months had seen more than 1 trillion rupees of monthly collection, I mean, center and state put together, of GST. So it was sort of stabilizing, and when the crisis hit, suddenly the collections came down to a trickle, and then they picked up later again. The fourth major change was a overhaul of the fiscal responsibility law in India. Uh, the law had been in place since 2003. It was passed in 2003, and there was a need, and there was a decision to suspend it after the global financial crisis, and because government wanted to have more fiscal room to be able to stimulate the economy. After that, several years later, it was brought back, but there was a felt, it was felt that there's a need to amend the law because, for example, the earlier law didn't have a proper escape clause, and therefore the law had to be suspended. So there was an amendment done in 2018 after a committee looked into these issues and recommended certain changes. So there were a few key changes out of that. One is that the now there's a focus only on fiscal deficit and debt to GDP ratio as targets. And the focus on revenue deficit and effective revenue deficit, which was introduced later, have been done away with. So there are, I mean, it is to be seen whether how it will affect, for example, capital expenditure and expenditure composition of the government. The second is that the fiscal consolidation roadmap has been redrawn. By 2024-25, government had planned to bring its debt to GDP ratio to 40% and fiscal deficit to 3% by 2020-21, and escape clauses and even buoyancy clauses, so which lead to I mean, faster fiscal consolidation if there's better economic growth, were introduced. And this was just in 2018, and these targets were meant for I mean, 2021, 2024, 25. But because of the crisis, this is also now up in the air. And so this is a slide which shows the deficit indicators of the government as deficit rose up after the global financial crisis. Then they started falling, and in recent years again they were rising. And this law was supposed to basically ensure that the government has some kind of a commitment to make them, I mean, to bring them down. And the fifth major change I'll talk about is the direct benefit transfer. I mean, it is a plumbing kind of reform, so it's not a policy law reform in that sense. It is to do with the mechanism of delivery of subsidies. But there has been a big change in just the quantum of subsidies being transferred through it, in kind and in cash subsidies. These are graphs that are made available by government on the website. You can see there's a huge increase in subsidies, in cash subsidies, and also later introduction of in kind subsidies, which is the orange bar, which has been going on for the last few years. The number of beneficiaries is also now very high. The in-kind subsidy, the number of beneficiaries registered is almost 60% of the population of the country. So there's been a huge scale up of that, and there's a political economy around this also. So this is also something which I would argue is a work in progress. There have been consequences of this. One consequence that I would like to talk a little bit about is who gets credit for the schemes, for example. So the National Election Studies that CSTS runs uh, ask this question about from beneficiaries. So people are asked, did you benefit from such and such scheme? If they say yes, then they are asked, who do you give credit for the scheme? And in 2014, the schemes that they asked for, most people, I mean, vast majority of the people gave credit to the state government. And when this same question was asked in 2019 for a larger number of schemes, the central government was the predominant I mean, entity that got credit for the schemes. And of course, these are not, I must explain, these are not mutually exhaustive categories, state government, central government, and there are others also. But these are the two entities that basically compete for credit. And by 2019, just in 5 years, even for the schemes that were asked earlier, for example, Narega, uh, more than 40% had given credit to state government in 2014, while in 2019, almost 50% gave credit to the central government, and only about 30% gave credit to the state government. So there has been a shift, and part of this has got to do with central government directly reaching the beneficiaries through direct benefit transfer, also publicizing its efforts and so on. And but this has political consequences because state governments then don't politically benefit as much as they would have otherwise. So these are just five changes that I have kind of emphasized, and these were all works in progress. But there are others also. There was restructuring of centrally sponsored schemes. There were merger of the railway budget and so on, which I'll not go into too much. Uh, Now, what was happening as a consequence of some of these changes? So, for example, GST and its struggle with achieving tax buoyancy early on, the change in the devolution of taxes to the states is that the center was struggling to maintain its receipts. So, last few years, initially there was a pickup in overall receipts, revenue and non with tax receipts as well as non-tax receipts. But then after 2016-17, when the economy started slowing down, there was a decline in the revenue receipts for the center. And that turned out to be a turning point for some of these transformations also. So the in 2017-18 there was a decline, there was a shortfall in non-tax revenues. In 2018-19 there was, and 1920 again there was a major shortfall in tax revenues, and government had to adapt to this situation. And when this happened, some of these reforms also got affected in some ways. So one of the ways in which the government responded is by basically reversing on something that was happening in recent years, which is a reduction in tax disputes. So there was a big rise in tax disputes, direct tax disputes, around 2010-11 in India. If you remember, there was a sort of a breakdown in state capital relations around that time, and there was a big rise since then for 5-6 years in taxes under dispute. This I have presented as a percentage of GDP. Then the nominal numbers look even scarier. And this was beginning to turn around 2016, 17, 17, 18. But as you see the government struggling to collect its revenue receipts, you start seeing that again the disputes started rising. And part of this rationale is that the revenue mobilization effort is partly directed by targets that are given. And if the targets are not met, that often revenue authorities make the claims and then the claims go into disputes. And then when eventually government loses many of these cases, there's data presented by a parliamentary committee that shows that government loses majority of the cases. But in that time, the money stays in dispute. And there's been a rise in tax disputes in recent years. And this is a sort of reversal of what was happening the 3 years previously to that. Then there's been a strategy that government took that to fund part of its expenditure by off-budget borrowing through public sector enterprises. So for its own expenditure on subsidy schemes especially, part of the expenditure it met by making public sector enterprises borrow on their books and then incur it, and later the government would repay this whenever the right time came, and the right time did come later. I'll talk about that. Uh, so, for example, in food subsidy, what used to happen earlier is that even though there was a lag in the release of a subsidy, because the subsidy is incurred during the course of the year, and you don't know by the during a year how much is the total subsidy. Only the last day you come to know. So, in next year you get some of the budget allocation for the previous year subsidies. But the government had a certain kind of strategy that which ensured that more or less the subsidy that was transferred to Food Corporation of India was all about the same as the total expenditure in that year. So it was, I mean, there was 5-10% here and there deviation, but in recent years, only about 50% or so of the subsidy was transferred to FCI, and the remaining it borrowed on its own books and incurred. So that was a direct reduction in the borrowing of the government, and that allowed the government to give a certain kind of what you can say is the off-budget stimulus around that time. And we should remember that this is also the time when elections were around the corner, 2017, 18, and 18, 19. Uh, so I'll show you a couple of graphs on this. So this is expenditure met through the resources of public enterprises. So government expenditure that is met through the resources of public enterprises, which will be internal resources or the borrowings by them. So this used to remain around 2% for many years. There are 4 years I've shown data for, and then it picked up suddenly in 2017, 18. Around the time economy started slowing down and government started struggling with its receipts, and then it stayed quite elevated, above 3% of GDP for 3 years at least, and even in recent years. Now there is a strategy to, I mean, reduce it, but that's just an intention that has been announced in the budget. Uh, then I mean, and one of the most significant consequences that flew from this struggle to maintain receipts is that there was a shrinking of the divisible pool. So, as I said earlier, when states get a share of center's taxes, they basically get a share of the divisible pool, which doesn't include cesses and surcharges or the cost of collection. Now, when government started facing trouble in maintaining its level of receipts, then it basically increased cesses and surcharges, especially on petroleum products. So the union excise duty on petroleum products, there was an increase in the in the cesses and surcharges, and it reduced the share of the states in the last couple of years that they would have otherwise got from the centers taxes. I'll just show you. I'll skip this slide, which is about the use of National Small Saving Fund for off-budget borrowing, but I'll get to this slide. So as you can see, the 15th Finance Commission report was implemented from 2015-16, which led to a small increase in the state share of of gross tax receipts of the center. So there are three types of transfers. The blue bar here is the transfer of share of states in the union's taxes as percentage of gross tax receipts. The second, the orange bar is the finance commission grants, and the gray bar is the other transfers. So the first two are basically based on the finance commission recommendation, and the third is non-finance commission transfers that government does through. Earlier, it used to be plan assistance of different types, and also under centrally sponsored schemes and so on. So obviously, as you can see that as the state share of central taxes went up, immediately there was a decline in the other transfers, because there is to be a substitution, right? Because otherwise, if you suddenly increase 10% the state share, how will the center pay for its expenditure? So the idea was that there will be a different change in composition of transfers. So the states get more untied funds, they can decide what to do with them, and the center will reduce some of the specific purpose assistance that it used to give. And this happened, and the net result was still positive for the states. And for a couple of years, it remained positive. So you can see 15, 16, 16, 17, roughly the same level of transfer. 17, 18, there's a slight increase also, because I'll come to why this has happened, because there's a GST compensation that has been given to the states, which was in lieu of the losses that they may make, or because of reduction in their collection of GST. But in 2018-19 and 2019-20, you see first a small and then a significant reduction in the states transfers to the states. And this slide is slightly understating the problem because it includes GST compensation. Let me explain a little bit what GST compensation is. GST compensation is basically compensation to the states that stand to lose from GST implementation, and these are usually states that were producing states. So GST is a consumption tax, and if there is a state that is much more on producing and it exports things to other states, it may lose some revenue because of the implementation of GST. So there is a promise made that for 5 years there will be a compensation paid to states if their revenue growth is not 14%, I mean less than 14%. So there is a compensation says that center imposes, and then it goes into a fund, and the states are paid out of it. So including that in the center's receipt or expenditure is actually not conceptually sound because this is a pass through. It is in lieu of what the states were earlier collecting. So this is not center's receipt or expenditure. It is center is just collecting it and passing it on to the state. So if you exclude that, which was anyway in lieu of what the states were getting, then you see a much sharper decline in the states transfers to states in 2018-19 and 2019-20. And this again, I would argue, is because of the problems that center was facing in its receipts. Another casualty of this last few years of difficulties on fiscal front has been the capital expenditure. Because many of the revenue expenditures are committed, their salaries, pensions, those kind of things, there was a slight decline in the capital expenditure as the overall receipts of center started falling. Uh, now I'll come to the point of uh, what is the total impact of all of this for government, central government's receipts in the last few years. In spite of trying all these things by reducing the divisible pool, trying to do off budget, trying to sell public sector enterprises to other public sector enterprises and those kind of things, still the government's overall receipts, which is net receipts that the government receives, were falling quite drastically over the last 3-4 years, and in the latest year was actually the lowest since the Finance Commission report was submitted and was accepted and implemented. So government was struggling with its public finances even before this crisis hit. Then the crisis came, and there were adjustments to be made because of the crisis. Because crisis budgeting is very different from normal budgeting. All the assumptions actually go haywire, and you need to basically go back and understand what is it that you can do under the circumstances. So I'll briefly just talk about what those adjustments were. So there was a fall in tax revenues, non-tax revenues, non-debt capital receipt, everything basically, all the major components of receipts fell. So government responded mainly by raising the excise duties. And how did they do it? They raised the additional duty and the cesses, which are not shareable with the states. And therefore, the states' share in the gross tax revenue fell to less than 29%, which, as you can see here, is the lowest since the Finance Commission report was implemented, and it is the lowest in the last 5 years. But for this year, the 15th Finance Commission had recommended only 41% devolution to the states, and 1% had to be kept for J&K and Ladakh because they had been reorganized. Another issue that required adjustment was GST compensation. So GST compensation cess has been levied, assuming a certain level of activity in the economy, but that didn't turn out. So states were faced with much larger shortfall on GST. There was a conflict around this, but eventually union government agreed to borrow and give the states about 1.1 trillion rupees as GST compensation. I mean, as a loan to make for the shortfall, even though initially it tried to basically argue that the state should borrow on this within the limits that they were given by the government. Uh, on the fiscal deficit, so So the adjustment were made on all fronts. So there was an increase in fiscal deficit by almost 4.8% of GDP over the previous year. And if you look at the composition of this fiscal deficit increase, about 0.4% of GDP was because of the fall in non-debt receipts. So uh, this is the and because government was able to make up for a lot of this loss in receipts by increasing the excise duties. Uh, then, interestingly, government took this opportunity to bring a lot of this off-budget borrowing that it had been doing through public sector enterprises on budget. Not all, but a lot of it. So, a large part of the loan to the National Small Savings Fund was repaid, which was about. So this all, in my estimate, adds up to about 1.5% of GDP, and about 2.9% of GDP was the additional expenditure, which was incurred during the year, and that led to an increase in deficit as well. And most of it, about 80% of this additional expenditure, is revenue expenditure. And what do we see about the strategy expenditure? That basically they decided that this is the year to do relief and not to stimulate the economy, because the economy was anyway going through many supply side constraints. It was facing many supply side constraints. So they put effort on revenue expenditure. So you see large increases over the previous year's expenditure on food subsidy, rural employment guarantee. This is Narega, social assistance scheme, public health, housing subsidy schemes, and other such schemes. And you see a slight increase in capital expenditure, whatever is there, 0.6% of GDP in roads and railways. But for the rest, there is not much increase in capital expenditure. The focus was on revenue expenditure. In addition, there is also some emphasis that the government laid on contingent liabilities. It took on some liabilities in the form of guaranteed schemes. So there was a scheme to let make the banks lend to small enterprises, and then it would be underwritten by government. So if the loan goes bad, then the government would repay part of it. So this is about the 2020 adjustments. What were the adjustments that were made in 2020? Now, briefly about 2021-22 budget. What is the fiscal strategy that seems to be indicated by what we see in the budget document? So there is going to be a fiscal consolidation of about 2.7% of GDP. So last year's 2020-21, the fiscal deficit was 9.5% of GDP. Now it's budgeted to be 6.8% of GDP. But if you look closely at what this indicates, since non-debt receipts are budgeted to rise by almost 0.6% of GDP, the actual consolidation, I mean, net of this is 2.7% or 2.1% of GDP only. And even this, remember that last year's deficit included this bringing of off-budget borrowing on the budget, which is already, I mean, expenditure has been incurred in previous years. It's only an accounting entry being made now to bring it on budget. So if you remove this, then the fiscal consolidation is very small. It's only 0.6% of GDP, which means that the government will continue to stimulate the economy and focus on fiscal expansion even in the coming year. And please remember that these numbers are on a higher GDP base, because GDP the denominator itself is expected to rise next year by a significant double digit. And what we see is that there is a shift in composition of expenditure. So from relief to stimulus. So there is the rise is primarily in capital expenditure, and capital expenditure, especially in transport and communication sectors. There's but there are also gaps. So there is the major gap in the budget expenditure is that there is very little, almost 20,000 crore expenditure that is budgeted for financial crisis. So decapitalization of financial institutions. They have proposed asset reconstruction company, but there is no budget provision for it. So there is a major gap that needs to be addressed, because if during this year the recapitalization is to be done, then this whole budget estimate can actually go haywire, because all the estimates are assuming that the financial crisis will not blow up. But the Reserve Bank of India is telling us that the NPAs are going to rise very sharply, perhaps by 7 percentage points in NPA, and therefore there will be a need for recapitalization. Uh, so as I said, there's a change in the strategy for expenditure. There's a big increase in capital expenditure, share of capital expenditure in total expenditure. If they achieve this, it will be the highest capital expenditure in many years in by union government. On the receipt side, the big bet they're making is on the rise in direct taxes and the continued ability to be able to tax the petroleum products through imposition of cesses and additional duty and excise duty. And suppose there is a rise in the petroleum prices, crude oil prices, then this bet may not turn out to. Secondly, there is also a push for disinvestment and strategic disinvestment, which is now being called privatization, as it should be. And there is a push now to end the practice of off-budget borrowing. Eventually, it will not end this year, but it will come down to a very small number, and eventually it will probably end. So this is what I see is the budget 2021-22 strategy. Now, briefly, I'm already way over time, but I'll just spend a couple of minutes on the 15th Finance Commission. And I'll stick to the main issues in what Finance Commission deals with, which is the devolution of centers' taxes to states and the grants in aid that they recommend. And what do we see in terms of changes? Now, this Finance Commission was interesting, and there was some controversy around it because of a couple of reasons. One was that there was some evidence that the union government is trying to claim some of its fiscal space back. As I showed to you graph earlier, that states' actual transfers from center, including devolution and other transfer, had actually come to basically the pre-14 Finance Commission levels in recent years because government was trying to cut down on all transfers and also reduce the actual divisible pool that the states get. So there was some anxiety that under this kind of a context, center would try to cut even more. And it didn't help that some of the terms of reference were quite controversial. One of them actually questioned the need for revenue deficit grants at all, which is actually under the constitution. It is the all finance commission is supposed to consider this. Then there was the terms of reference on performance-based incentives, which many more states were unhappy with because they asked why should union be able to put performance-based requirements on transfers to states. And there were other conditions which were specific to certain states. For example, the reference to 2011 census figures, which some states were worried would put them at a disadvantage because they have been able to control their population. So on. So there were quite a few anxieties around the Finance Commission. And also, as I showed this graph to you earlier, if you look back at the previous Finance Commissions, whenever there has been a big increase in the state share, in the following Finance Commission, there is some kind of a reduction that you see. This has happened a couple of times, and in political economy, these kind of settlements can happen, and these kind of pushbacks can happen, and one level of government can claim back the space that it gave up. So this was the context in which the Finance Commission was working, and what it did is that it stuck to the state share that was there in the 14th Finance Commission, but with one change that out of the 42% of the divisible pool, 1% would be going to J&K and Ladakh after the reorganization, and 41% would be divided among the states. Now, but interestingly, it actually now assumes that the divisible pool will continue to be only about 75% of the cross tax revenue. So cesses and surcharges will remain very high, which means that even though the share of the states in divisible pool is 42%, the devolution is as percentage of gross tax revenue is only about 31%. So now compare this to the 14th Finance Commission projections. There it was 37.2% of the gross tax revenue, which means that now it's a new normal that even though the share of the divisible pool will remain the same, the divisible pool will become a much smaller part of the gross tax revenue. So this is going to continue to happen, and Finance Commission can't do much about it. I think I've heard argument that should have looked into it because the jurisdiction clause in the Constitution, which is Article 270, itself excludes Finance Commission from considering cesses and surcharges. And this is something that union has the power to uh, change whenever it wants. Now, how will this be divided among the states? So there have been a couple of key changes that the Free Finance Commission has recommended. One is that it has added a criteria of tax and fiscal effort by states, and depending on that, there will be an inter-say sharing among the states. there will be a criteria of demographic performance, which is depending on the total fertility rate and the 1971 population. They will give the states which have been able to bring population under, the fertility rate under control, they will be benefiting from this. And in a way, this is something that the 14th Finance Commission had tried to do in a crude way, because it had taken both the latest population for 2011 census and the 1971 census into account while giving the state share, so that the states that were able to control their population are not disadvantaged in a big way. This time they have said that the population will be considered will be only the latest, but demographic performance will be taken as one of the criteria. Income distance roughly remains the same. Forest and ecology also, there is a slight increase in the share. Area, the weightage remains the same. And so there are a few changes, and some states that will benefit from some of these. For example, demographic performance, the southern states will benefit much more from it. Tax and fiscal effort, some states which have been able to do this well. For example, UP has a much higher tax to GDP ratio than GSDP ratio than one would expect. They'll benefit from it. So, but overall, this is not a very radical change as far as the share of the states is concerned. There is also a rise in the grants in aid, which the Finance Commission has recommended. Uh, there's a small rise in revenue deficit grant. There's a there's an increase in the local government grants. But interestingly, a couple of grants that the 14th Finance Commission has discontinued, which is the sector-specific grants for certain identified sectors that the Finance Commission wants to fund, they have been reintroduced by 14th Finance Commission, and certain space-specific grants have also been reintroduced, interestingly. And disaster management grant continues and has been increased. So there is a shift in strategy that the Finance Commission seems to suggest, that partly could make up for the short loss that the states are going to face because of the fall in their receipt of gross tax revenues. Uh, but they have also added performance-based incentives in some of these grants. So there are 4 areas in which they have suggested that the grant should be based on certain performance, and the monitoring of this performance will be done by center, mainly by NITI Aayog, but for a couple of them, some ministries are supposed to be monitoring, and that is something which the states are not going to like. And similarly, they have restructured the local body grant also, which is something that all of us in recent years have been suggesting, that the local body grants are given by the finance commissions, and they have done away with a significant part of the performance-based grant, which was a proportion, which used to be one component of this local body grant that was given to rural and urban local governments. And there is a small performance-based component, but most of it is now either untied or earmarked, but not performance-based. Performance-based is now almost gone. It's basically now any local body can claim based on some entry-level conditions, which are very basic about online availability of accounts. And then there are some, for the urban local bodies, there are some performance-based requirements that are put in place for the larger cities, but not for the smaller cities. They are supposed to be able to access the funds as they've also indicated a path of fiscal consolidation. So, uh, although this is just indicative, this is not binding certainly on central or state. They expect that by 2025-26, the states with GSDP fiscal deficit will go to about 3% of their GSDP, and the union's fiscal deficit will come to 4% of GDP, and the liabilities will also fall, but obviously not according to where FRBM Act had said. So we are looking at a very long path towards general government debt to GDP ratio of 60% and fiscal deficit ratio of 6%. It's going to take some time, and this is quite a optimistic scenario that the Finance Commission has shown. So I'll stop here, and I'll invite Josh to share his comments on the interpretation that I've offered, and also his views on what is happening in finance.
Okay. Yeah. Let me see if I can share a screen. Okay. I'm sharing. Okay, you can see my screen, right? Hello?
Yes, I can see. I can see your screen. Yes.
Okay. And okay, so the easy thing, especially since I'm short on time, is I should just say that I agree with everything Suyash said, and then I'm done. But of course, that's not what I'm supposed to do. I'm supposed to make some comments of my own. So let me talk about something that I'm going to call the DDG problem. So rather than talk about what was in the budget or what was in the Finance Commission report, I want to talk about things that were not in the Finance Commission report and not in the budget, and problems that have not been addressed and that are going to need to be addressed over the coming years. And I focused deliberately on pretty intractable problems that cannot be solved in the next year, because I want to give you an idea of the big issues that are going to be with us for a long, long time. So that this presentation is not just valid today, but will continue to be of interest even maybe 5, even 10 years, maybe 25 years from now. So what is this DDG problem that I'm talking about? By DDG, I mean debt, devolution, and growth. So let me start right away to talk about the debt problem. Take a look at this graph. What this graph shows you is pretty obvious. Debt was humming along at around 70% of GDP, not really going down much, but not going up either. It really wasn't an issue. In fact, debt really hasn't been an issue since 1991. We haven't really been thinking about it. You know, finance commissions report on it, and FRBM commissions report on it, and the government has objectives, but nobody really focused on this issue until the COVID year. And if you look at the right-hand side of the graph, you can see that suddenly debt has shot up tremendously. And now debt is going to be a problem, and it's going to be a problem for the next, I don't know how many years. So basically, we're seeing the return of the debt problem that we haven't thought about since 1991, and we're going to have to start thinking about it again. Suyash showed you another table which showed that according to the Finance Commission's projections, that debt is not going to disappear. It's going to stay high. It's going to stay around 90%, even through the medium term. All right, so how should we think about this? Well, the most important thing is the government needs to make sure that the debt doesn't explode. And I've put up a little equation on the screen. And the only thing I want you to get out of this equation is that the evolution of debt depends really on two things. It depends on the primary surplus of the government, which is to say the government's revenue less its non-interest expenses. And it depends on the interest growth differential. That is to say, because as the government interest accumulates on the debt, that pushes up the debt. And as growth proceeds, growth pushes down the debt to GDP ratio. So I want to focus on these two items as key for thinking about how debt is going to evolve. Now, if you look at the past, what you see is that India has had primary deficits, which would normally push up the debt ratio. But it's been offset by very favorable R minus G. That is to say, the difference between interest rates and growth has been very, very negative. Growth has been much higher than interest rates in real terms, and therefore that tends to push down the debt ratio. So you've had two things going on, the primary deficits pushing up debt and the R minus G pushing debt down, and on balance, debt has remained pretty stable. That's the good news. Now, I want to show you the exact same graph and talk about the bad news. The bad news is that if you look at the graph in another way, what you see is that the R minus G is highly variable. That red line jumps all over the place. But the yellow line, the primary balance, is pretty stable. And that's going to be an issue. And I'll explain why. So you have two policy choices facing the government. The government could try to go back to the status quo before COVID. It could try to keep the primary deficits at the before COVID level, say around 3% of GDP, hope that R minus G remains favorable, but as it did in say the 10 years before the COVID crisis. But the problem is, the risk there is that without a coherent debt path, without any plan to attack the debt problem, investors at some point could panic. And we just saw that R minus G tends to jump around a lot. It could jump up. And in that case, the government would have to adjust the budget stance in order to remain solvent. Now, how easy would it be to adjust? Assume that R minus G climbs to 1%. That's a very, very minimal assumption. That just means that interest rates are marginally higher than growth. Interest rates could easily be much higher than the growth rate. But let's just assume 1%. Then that equation that I showed you earlier implies that the government needs a primary surplus of 1% of GDP. Now, that would represent an adjustment of 4 percentage points from 3% of GDP deficit to a surplus of 1%. So a change of 4. That's twice as much adjustment as occurred during the crisis year of 1991. We know that that would not be feasible. We know it and markets know it. So this is a possible strategy, but it's an extremely risky strategy because India could be forced into adjustment which it cannot achieve. And that's a very dangerous situation. So what's the other strategy? The other strategy is to be preemptive. That is to say, gradually wind back the primary deficits. Now, the key word that I want to emphasize is the word gradual. Why gradual? Well, obviously, you need to avoid undermining the recovery, right? You don't want a very sharp fiscal adjustment that could kill demand before it really takes off again. And also, if you have a gradual plan, then it might just be feasible. And a feasible plan might just be implemented, and an implemented plan becomes credible. So if you have a strategy of gradually winding back the primary deficits, you could lock yourself into a virtuous circle whereby you adjust, credibility improves, R minus G improves, and that in and of itself speeds the reduction in debt. That's going to be a major challenge. It wasn't addressed in the report, it wasn't addressed in the budget, but this is going to be the big challenge of the next 5, 10 years. Can we actually achieve this gradual winding back of the primary deficits? I go back to the chart before, which shows history isn't really encouraging on this score. Okay, now let me talk about devolution for a few minutes. Now, the focus in including in what Suyash said is how much devolution to states. So how much of the divisible pool, say, is being shared with the states. And then after that, people worry a little bit about how much each state gets from this divisible pool. What's the allocation formula? Suyash talked about that. But what nobody talks about is what's the distribution of devolved resources among states? And this is a very, very important question because there's extensive redistribution of revenues that's going on. What are we talking about here? Well, if you think about it, all the revenue in India is generated in states. Now you can take two, the center doesn't, the center doesn't really control any activity. It's just an efficient mechanism for collecting taxes that are generated in the various states. So you can have two perspectives here. You could take an extreme federalist perspective, and you could say states should keep their own revenues, the revenues that were generated in their own state. Or you could take an extreme centralized perspective saying, no, we're one country, doesn't matter where the revenues are generated, they should flow from the rich states to the poor states, it's only fair. Now, there are arguments on both sides of these, but clearly you need to have some balance, right? India is a federal republic, but it's also one country. And so you need some redistribution, that's only fair. The question then becomes, how much? So let me show you some charts here. And I really don't have time to explain them quite adequately. But if you measure redistribution, redistribution has gone up very, very significantly. Went up a lot under the 11th Finance Commission. It went up, it kept going up under the 13th, 14th, and it's gone up again under the 15th Finance Commission. So the question is, again, what's the limit here? How much redistribution can we have? And this becomes a particularly acute problem when you start looking at redistribution by state. So on the left-hand side of the graph, I'm showing the contributing states. And on the right-hand side, I show the benefiting states. Again, I have to move quickly here because I don't have much time, but you can see that the states that are contributing here are in the West and the South, and the states that are receiving are mainly the Hindi heartland and the Northeast. The point here is that these ratios are extremely large. Look at Haryana. The redistribution amount is about 75% of the revenues generated in the state. That's huge. And similarly, on the other side, you have, say, UP with redistributive receipts equal to 65, 70%, and Northeast, of course, much, much more. So there's a problem here. The problem is that when a state transfers revenue that's generated in the state out of the state to other states, that inhibits their ability to provide services to residents. And at some point, they're going to say, that's it. We cannot transfer anymore because you're really crimping our ability to provide services that people are demanding and needing. So over the next decade, this problem is going to become increasingly pressing. We're going to have to confront the question, can these resource transfers keep increasing? If so, up to what point? And if not, what are we going to do? All right, third problem, growth. Now, of course, this is not we're not really discussing growth in this webinar, but growth strategies are laid out in the budget. What people expect from budget is that there will be 1, 2, 3 measures that are going to be announced that are really going to create a boom in India. And I think that's a very wrong perspective. And I want to explain why. And I think we need to reorient our perspective if we want to put India back on the path of rapid growth. So I want to ask a question. The question is, this government has undertaken some truly major reforms. It's undertaken GST to build a common market. It's undertaken introduced the IBC to deal with the bankruptcy problem and capitalism without exit, inflation targeting, all sorts of pro-market measures like foreign direct investment liberalization, the biggest corporate tax cut in history, and new welfareism schemes. Now, by new welfareism, I mean providing essential goods and services to poor. Now, so by any standard, this is a pretty impressive list. But when you look at the growth performance, you see that the growth performance has been very disappointing. There are problems with the GDP numbers. So I've broken things down into various components: exports, imports, investment, government expenditure, and what you can see in the graph is that the performance on these various measures has been extremely disappointing compared to previous governments. So that leads to a question: why is there this disjunction between these tremendous reforms and the very poor growth response? Well, you can argue that it's just too early. You need more time for reforms to pay off. And I completely agree with that point, although I will point out a very important point, that transformational measures require tweaking to achieve their objectives. Suyash mentioned some ways in which the GST has been tweaked to make sure that it achieves its objectives. I would say that at this point, more than new measures that will solve the growth problem, what the government needs to do is focus on these tweaks, focus on these adjustments to the existing reforms to make sure that they're working. In particular, this applies to the IBC, and which has been suspended, of course, and even when it was operational, was not working as well as we had hoped, but it also applies to GST. That's one part of it, but even so, you have this feeling that something is missing somewhere. And what I want to argue in my 2 or 3 minutes available is that what's missing has been software. Now, what do I mean by software? What I mean is the way that policies are formulated, articulated, and implemented. And what I want to argue is that the state, not just this government, but the Indian state, has been able to deliver hardware like toilets, digital infrastructure, physical infrastructure, but the state finds it very difficult to design and implement policies. What are the elements of software? I would emphasize 5. First, you need good data. You need to make sure that decisions are being taken on the basis of data that's correct. If data is not correct, then you're going to make policy errors. And this data has to be provided transparently to the public, because that is the way you build public trust in the government. We know that there have been data integrity problems. Suyash mentioned all sorts of off-budget activity that people couldn't see. Fortunately, that's been brought back on budget, but there are many other problems that still need to be resolved, particularly, as I mentioned, on GDP. The next step is, once you have good data, you need to make sure that the decisions are fair in fact and in perception. Why do you need that? Because you need to make sure that firms, households believe that there's a level playing field. That, for example, small firms will be treated equally well with large firms. All large firms will be treated the same. This is necessary for ending the perception against the stigma against private enterprise, the feeling that some firms are favored and other firms are disfavored, and therefore there should not be any market-oriented reforms, because that will just lead to the triumph of favored firms. Then once you have good policy based on good data, fair decisions, you need statecraft. You need to be able to sell these decisions first to the Lok Sabha and the Rajya Sabha and to the wider public, and especially to the states. Why? Because nearly every major issue requires joint action, especially with the states. And then once you've implemented the policy, you have to make sure that it's implemented in a consistent fashion and not overturned by subsequent measures. So for example, when you announce a tax policy, you can't have retrospective taxation, because then investors will fear that if they invest, if they make a profit, suddenly, based on existing tax law, suddenly that profit can be taken away from them, in which case they won't invest. Similarly, you need rule of law. That means contracts, not just explicit contracts, but the implicit promises. They need to be implemented punctiliously, even-handedly. Okay, now I'm on my last slide. Just consider the rule of law for a moment. India scores very, very poorly on the ability to enforce contracts. There are disputes with contractors, especially on infrastructure projects. There are arrears to suppliers. There's anxiety about arbitrary government action that Suyash mentioned. He showed the tax disputes creeping up. All of these problems lead to a huge bias in economic activity. Means that firms are reluctant to undertake major infrastructure projects or large-scale investments in manufacturing. Instead, they want to focus on smaller scale activities such as trading. So if you really want to convince firms to make in India, you need to improve the rule of law. So I'm done now. So these are, none of these things can be solved in an instant. All of these problems are very intractable. The debt problem can only be solved with a determined plan over a long period of time. The devolution problem, we haven't even come to grips in thinking about this problem. And the software problem, again, we haven't really focused on these issues. And even when we do, it'll take a long time to come to grips with them. So, but I think these are the key issues going forward, and the key issues that are going to be concerning us for the next 5 years, 10 years, maybe the next rest of our lives. Thanks very much.
Thank you, Josh. We are way over time, but I think we'll take a couple of questions. One question that I think you should answer is from Vivek Joshi. What is the risk of rating downgrades and likely impact? How does the current reflationary environment, rising yields, affect the budget arithmetic?
Yeah, great question. I think that risk of rating downgrades, absolutely, of course. The rating agencies have been very, very cautious during the COVID years. They haven't downgraded anybody, any government really. And the reason is because they know, they're all waiting to see what are the plans, what are the plans for dealing with the huge increases in debt. If they see credible plans coming out of India, I think they will be able to retain their ratings. But of course, if they don't, then it is their duty as rating agencies to warn investors. And even if the rating agencies don't perform their duty, investors will draw their own conclusions, as the question implies. I mean, they're already starting to draw their own conclusions in the global environment. They're already starting to push up interest rates. So yes, this is going to be, as I said earlier, this is going to be an issue that we're going to have to struggle with for a long time.
There's one question: what's driving the reduction in central government receipts? I'll try to answer that, and please feel free to add, Josh. So if you see the trend in receipts, I put up a couple of graphs on this. The decline in receipt as percent of GDP starts around the time the economy starts to slow down. So there is an underlying economic activity slowing down, and one of the drivers of this decline in receipts is also that. The other is that GST introduction. So when GST was introduced, uh, it took some time for that new system to stabilize. In the first couple of years or so, the receipts were actually far less than they were initially anticipated. The third is on non-tax revenues. So non-tax revenues, they primarily things like spectrum auctions, proceeds, dividends from RBI and public sector firms and so on. So one of the years, RBI dividends was very good, very high, but for other years, the dividends overall as a category have remained quite low. And spectrum auctions, every year they're budgeted to do a spectrum auction of 5G, but it's not happening for the last few years. So the spectrum auction proceeds have been quite low, which this was a key source of non-tax revenue for quite a few years. And this has been quite disappointing in recent years. And then fourth, of course, the non-debt capital receipt, privatization, disinvestment. Year after year, we're not able to meet the target. Primarily, in my view, is that doing strategic investment or privatization is very difficult in India because nobody is willing to sign off on a transaction like that. Because last time we did privatization under NDA 1, there was a long process through which the bureaucrats and the minister concerned went. There were legal battles and all, and now nobody wants to do that. And therefore, from 2016 onwards, when government decided to do private strategic investment, it's not been able to do even one privatization. So after almost 5 years of decision, it's not able to implement even one transaction. So these are some of the reasons because of which the non-debt receipts have struggled in the last few years. Josh, do you want to add?
I just want to add one thing, which is that all of these things, there's been a kind of dynamic at work, and the dynamic goes, you draw up a budget, you assume that because of all these great reforms, the economy is surely going to take off, and then there are going to be a lot of tax receipts, and you can draw up your budget based on this. And time again, what the government has seen is that they've been disappointed. The economy has not taken off the way they hoped. And then they faced a problem. And the problem was that in order to hit the budget deficit targets, they pushed all sorts of spending off budget. Now, what I hope in this budget signals, the current fiscal 22 budget signals, is an end to that dynamic. Certainly, they've adopted a fairly conservative growth assumption. It's highly uncertain because we don't really know how economies rebound from pandemics. But compared to, say, private sector economists, the government has been very conservative on the growth side. And it has brought expenditures back on the budget. And so it looks like it's learned its lesson. But but I think the jury is still out on that one.
Thank you, Josh. Unfortunately, we have to stop now. We have taken much more time than we had originally budgeted. Thanks to me primarily, but also 5 minutes thanks to you. Thank you for joining me. Thank you. Thank you for joining this seminar. Those of you who missed parts of it can catch this on YouTube. Thank you, and please join us for our next political economy seminar, which should happen in a couple of weeks. Thank you, Josh.
Thanks, Yash.